Welcome to this session. In this session, we'll be talking about pips, leverage, and other stuff. So just follow closely. Now, the price difference we talked about in the previous session was broken down into pips. So before we talk about pips, we're going to talk about spreads here. Because I missed this session. Now, spread it can be thought of as the difference between the highest price that a buyer is willing to pay for a currency and the lowest price for which seller is willing to sell it to. Therefore, when buying a currency, traders will be quoted two prices, that's the ask price and the bid price. The difference between those prices is the spread. That's the difference between the ask price and the bid price is the spread. This is basically how brokers make their money. So they are not giving you the access to the financial markets freely. They are making money from spreads. So the little spreads there are their own means of income. So combined with many retail traders and the spreads they have there is where the brokers make money from. That's some huge funds. So let's take an example of spreads. Like you have USD card here. If you're quoted USD card, if you are taking USD card trade, you'll be having something like let's say you are buying at 1.35 thousand. Your broker will put two price, that's 1.35 thousand and 1.35 thousand. In this case, your broker will be giving you USD card which you wanted to buy at 1.35 thousand. The broker will be giving you the spread, the pair at 1.3533, taking the spread of 3 pips. That's where they charge you 3 pips. That's where they make their own income. So basically, USD card bought at 1.3530 will be given to you at 1.3533. And on the flip side, that's on the sell side, if a trader is to sell USD card at 1.35 thousand, the broker will execute the trade at the level but still charge the spread when the trader buys back the short position. So spread can be influenced by a number of factors, including supply and demand and total trading activity of the currency pairs. And sometimes the spreads aren't fixed. Some brokers also have fixed spreads, or maybe some Forex account doesn't have fixed spreads due to the fact that you won't have the amount or the huge amount of money that requires you to run a trade or run your trades with fixed spread. So mainly we use 0.3 spread. Now, when trading with a broker, spreads usually appear on one or two fronts. That's variable and fixed spread. As the name implies, the variable spread fluctuates throughout the day due to change in market condition and overall liquidity. Mostly, spreads become wider, more bigger during the night time, and some pairs have high spreads. So that's why you should choose the pairs you should be trading and choose a good broker too. So on the fixed spread, on the other hand, remains constant or unchanged regardless of market conditions. There are many places where you can get this fixed spread, especially on prop terms. That's where you can get some fixed spreads. Then if you are using a fixed spread in SNS broker, that means you should have up to $1,000 or $700 to trade with. and it feels good trading with a fee spread, because you won't have anything to panic about. Price doesn't take you out at the wrong place due to your spread size, and it's always good to use. Now let's get to what we have. That's pips. Today the pips is the difference we talked about. The price difference we talked about in the spreads was broken down into pips, which is the smallest unit of measurement in the forex market, usually quoted to 4 decimal places. That's 0.0001. In the case of USD card, which we used in the example above, the spread between 1.3530 and 1.3533 is 3 pips. That's calculated from this 4 decimal place. We added 3, that's 3 here, that's 3 pips. Now in forex trading, the pip is the smallest price change that a currency pair can make. For example, GBP USD open at 1.5450 and close at 1.5400. The pair lost pips, 50 pips on the day. That's, if you calculate from here, from the decimal places, you shouldn't check this. You are checking from these decimal places. 5450 minus 5400, you have 50. That's, if you're longing and you get this drawdown, that's 50 pips drawdown. For most parts, calculating pips is as easy as adding and subtracting, since the smallest move in the most major currency pairs is 1 basis point. However, this isn't always the case. For example, in JPY pairs, all JPY pairs has different spread. They are calculated from the second digit. They are calculated as opposed to 4. They are calculated from the second digit. That's if this is to be GBP USD, let's say we have 181.00 and we bought it from there and close at 181.50. that means we have got 50 pips already. So I think JPY pairs are very easy to calculate too. All pairs are easy to calculate the pips. You just need to know is if it's JPY pair, you have your pips at the second. You calculate from the second decimal place. But if it's other pairs, you can be calculating from the 4th decimal place. That is other major pairs mostly. Now we have leverage and margin. One of the biggest draws of forex trading is the ability to control a large amount of capital using very little of your money. In forex, this is called leverage, and it involves borrowing a certain amount of trading capital needed to buy a currency. For example, if a broker offers 100:1 leverage, traders can control $100,000 position on a mere $1,000 deposit. This is huge, like you controlling $1,000, $100,000 just with your $1,000 deposit. That's cool, but as you can easily tell, leverage may be an incredible way to amplify your earnings. After, if your position rose to $101,000, your return is $1,000. That's a gain of $1,000 on an initial investment of $1,000. Sounds great, but that works in reverse too. Leverage can also amplify your losses. If that $1,000 position were to fall by $1,000, $100,000 was to fall by $1,000, your initial deposit could be wiped out immediately, leaving you with zero. Remember that 1,000 initial deposit you put down to control $100,000 pot money. That's called margin. You need margin to use leverage. So if you're using brokers, most brokers give crazy leverage. They even give from 500 to 1 or even greater. For remember, just you have to remember that leverage is a two-way street, a double-edged sword, and insert any other cliche that works for you. New traders are strongly advised to stay away from leverage or use it sparingly until they learn the ropes. Like if I'm advising you to use leverage and you just use the one that was there when you was creating your accounts, you shouldn't change it unless on important cases or when you know how to use it very well. Now let's get to risk management. This is the most important part of forex trading. Risk management refers to the set of tools and methods traders use to minimize or remove financial risk from their decision maker. It is widely regarded as one of the most important aspects, like it's the most important aspect of trading in any financial market, be it forex or crypto or otherwise. Although it's impossible to know what will happen in the future, there are certain steps traders may take to minimize their exposure and ensure they don't blow their account in one or two really bad positions. So this is risk management. You have to take it. So let's get to it. The following strategy should be part of any forex traders risk management. Please get close. You need to learn this. Now, risk reward ratio. Based on your analysis, the risk of entering a trade should be well below the potential rewards. The minimum risk reward ratio traders should use is 1:2. 1:2. That is potentially, like, let's example, we have potentially risking 10 pips to make 20 pips, or let's say we have to increase it, we say potentially risking 20 pips to make 40 pips. That's the least risk reward ratio the trader should use. Now the second rule, 2% rule. If you really want to minimize downside risk and have opportunity to make more trades, you may consider not allocating more than 2% of your entire trading capital on a single position. If you have $1,000 in your account, no more than $20 should go towards one trade. No more than $20 should go down on one trade. That's very important. Let's get it down. If you have $100, you shouldn't lose more than, or let's say $2, because this is impossible sometimes. So you have to stick to it. Risk management is really very important in trading. Now this is another part of it, using stop loss and take profit. The stop loss is an order to sell a currency when it reaches a certain price, allowing the trader to limit losses in the event of a bad trade. A take profit, on the other hand, works in the opposite direction, allowing traders to lock in profits by closing a trade once it reaches a certain price. You shouldn't be foolish or greedy while trading, so you should use this stop loss and take profits whenever you can. Even all the time you should use it. This is very important. You should be using stop loss and take profit. I will explain more further. Now, diversification. Another risk management plan. Another risk management rule someone should have. Don't put all your eggs in one basket. Consider trading more than one currency in order to minimize the negative impact that any one position can have on your profitability. Like, this is very important. Most new traders are good at opening many positions on one single pair. You see somebody buying gold on 4 positions with high loss and using maybe a low funded account. That's not good. You shouldn't put all eggs in baskets in one basket. You should diversify, trade different trades. Not like opening so many positions on a trade. It's very important. Despite being a forex platform first, Easy Market offers access to 300 markets in the currency, commodities, indices, and option markets. Mostly we trade currency pairs here. So if you are trading currency pairs, you should not you should not be trading one currency pair and using investing everything you have in it. It's too bad. Now, technical and fundamental analysis. In one of our previous sessions, we talked about the forces of demand and supply involved in moving currency one way or another. But what about the techniques that traders use to analyze the direction prices are moving? That's where technical and fundamental analysis come into play. Technical analysis is the use of past market data such as price and volume to predict future price movements. Technical analysis is the single most powerful method of evaluating currency prices and is relied upon by majority of traders. It is important to keep in mind that technical analysis doesn't try to measure currency intrinsic value, that is what the currency is really worth. Instead, it helps traders to identify price patterns that may predict future activities, thereby improving entry and exit points. Now, there are so many technical analysis methods and techniques out there that would be impossible to name them all, let alone cover them in depth. What you need to know is that technical analysis is mostly used to identify trends and determine breakers and reversals. As you start playing around charts and looking at things like trend lines, oscillators, and moving averages, you slowly begin to appreciate technical analysis. You also develop a newfound appreciation for charts with squiggly lines. The forex market is essentially a club for charting enthusiasts. So when you start trading, learning technical analysis, you understand more about this. I might drop a link to technical analysis course under this video. That's very important. Now, fundamental analysis, on the other hand, does attempt to measure intrinsic value of a currency. It involves studying related economics, financial, and other qualitative and quantitative factors that may be influencing a currency price. Many forex traders who don't have a background in economics or monetary policies don't like fundamental analysis and choose to ignore it altogether. That's probably not a good idea. Things like central bank statements, interest rates, economic growth, indicators, and insights about future government policies all have a direct impact on currency rates. So we should take this fundamental analysis to test. Normally in our groups, my groups I normally post fundamental analysis, fundamentals if there is any before the day starts. So you should stick to it. To know more about fundamental analysis, you go to Forex Background. I'll drop link in the groups too. So traders absolutely need to pay attention to this if they want to succeed. After all, trading doesn't occur in a vacuum, but in a dynamic market with lots of influencers. In fact, some of the biggest price movements occur immediately a fundamental news release. For example, the Swiss National Bank removal of its 3-year old peg on AUR/CHF exchange rate in January 2015. This move not only caused absolutely staggering losses for euro, it put many forex traders and forex brokers out of business altogether. So we should always take this to note. Fundamentals are very important in the market. Now, I'm going to drop 10 powerful trading tips that we all have to take into consideration. This tips is very important, so you have to take note of this. Now, I think now you should have the basic understandings of the in and out of forex markets. Then these 10 tips will help you start your trading career on the right foot. Now, before you start forex trading, you should define your goal. Identify the reason you are trading and what you hope to achieve from it. Most people who trade the financial market do so with an end goal in mind. The trading itself isn't a goal, but a means to that end that traders hope to achieve. Identify precisely what you want to achieve in Forex. This will not help you. This will not only help you stay motivated, but ensure you adopt the right trading approach for your personality. That's number one. Number two, choose a high quality broker. The importance of choosing a right broker cannot be stressed enough. This should be on your immediate to-do list. To narrow down the field, ensure that the broker is regulated, has been in business for more than 10 years, has good management options available to you, offers a good mix of products to trade. This will ensure that you don't outgrow your broker as you progress as a trader. The next is start slowly. Most new traders make the mistake of opening too many trades. Opening too many trades. Like, this is very important. A couple of my students have done it and lost their accounts. And this, this doesn't make it hard to drag them off, but also exposes them to unwanted risk. Like, when you open so many trades at a time, you won't have the good energy to drag them out, course. Now this time now you'll be panicking. Let's go. Like, you won't be at rest. Your mind would be at rest. So when opening trades, you should take at least two, at maximum take two. Now new traders should focus on fewer trades at first and spend more time researching the best position to take. Like everything else in life, slow and steady is the best approach when starting out. For research every trade you make. Becoming a successful trader requires patience, hard work, and a lot of research. Before you take any position in currency, make sure you research the market thoroughly. It simply doesn't make sense to throw your money on a trade that cannot be backed up by technical or fundamental analysis. So you should research every trade you make. Look for trends. Forex traders spend a lot of time analyzing charts so that they can determine the underlying trend. This is extremely important as it helps you to predict the future price behavior. Analyzing price behavior may also allow you to see price reversals and breakouts, which provide huge opportunity for profit making. Reputable brokers should offer you free trading signals and technical analysis to assist you in your trading. Now, the broker I'm recommending, guys, is mostly SNS, and I also recommend IONFS and Evertrade. These brokers are very reputable because they provide you with fundamental analysis mostly. So, but many traders like many brokers like BD Swiss do provide technical analysis and signals. But so everyone that's in my group, I give you guys free signals daily. If you're not in my group, I might drop the link to my Telegram group at the end of the video too. Now the sixth one is to preserve your capital. As a forex trader, your strategy should involve not only making profits but preserving it as well. After all, profits cannot be kept of little use to you. So let profits trades long, cut losses quickly, and utilize stop loss and take profits. I mentioned this earlier during the risk management options. You should always use take profits and stop loss. So build and refine your trading system. There's a reason why there are so many trading strategies out there. They all work to a certain degree. The success of any one system will depend on the skill of the trader. the amount of time they can devote to trading, and their ability to respond to changing market conditions. Now, new traders often find themselves constantly refining and adjusting their trading strategy. You should do the same as you build your experience in the market. Now, the eighth tip is don't overreact to a loss. Losses in forex market are expected. Like, this is what you should expect. When calculating your profit, you should also calculate your loss too. That's the game. We make profits, we lose too. So don't let anyone else tell you otherwise. This is why some traders are only allocate up to 2% of their trading capital to any trade. With this kind of risk management strategy in play, you may afford small losses. The loss shouldn't make you lose confidence in your trading strategy, especially if it has been thoroughly researched. It's only when you are running multiple big losses on a weekly or monthly basis that you may consider adopting a new strategy. Now, always review the financial calendar. One of the first thing you should do at the start of each week is review the financial calendar for key events that could impact your currency trading. These things like economics data and central bank meetings, that's the fundamental news, so that you can plan your trading week accordingly. Now, I said this earlier, to check the news fundamentals, you can be going to www.forexfactory.com. That's the best place to check the economic calendar. Last one is monitor your performance. It's extremely important that you monitor your profitability over time, preferably with a spreadsheet or pen and paper. This not only helps you to see whether you are progressing towards your goal, it can help you identify shortcomings so that you can fix your strategy or adopt a whole new approach altogether. Forex trading should be a long-term endeavor. Monitoring your performance is one of the best ways to ensure that you are making progress. Now we have the conclusions here. As you can imagine, this short introduction only scratched the surface of 5.3 trillion per day forex market. That's awesome. Just this short introduction. However, it provides you with all the basic concepts and information you need to learn before deciding whether to open up a live trading account. If you're interested in diving deeper into this exciting market, the following resources will give you everything you need to know about getting started. You have to go through this video again so you can understand more. Then, if you're ready to start earning with Forex, you can create a live account with this link. I'll drop the link under my bio. The link is under my bio. Check it. Just create a trading account from there and join my signal room. You can join my WhatsApp group. I'll drop my WhatsApp link and drop my Telegram link too. Or you can copy it from here and join. Thank you. See you on the other side.